Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be talking about accounting for merchandising operations, which is a fancy word for accounting for retail business. Uh, it also includes accounting for manufacturing. We'll get a lot deeper into manufacturing in Principles of Accounting 2, but for all intents and purposes, Chapter 5 and everything this week relates to accounting for retailers, accounting for products, right? So I want you to get into the mindset of a retail operation or a manufacturing operation. And what do I mean by that is think about your favorite retailer. Think of Macy's, Amazon, wherever you all like to shop, okay, for your physical products. And so uh, today, for both chapters 5 and 6, we're going to be talking about accounting for actual merchandise. So when you hear merchandise, think of product that you would normally buy from somewhere, okay? And that's what we're going to be talking about today with accounting for merchandise operations. It's really accounting for retail. Okay. And we're going to talk about that in chapter 5. And then in chapter 6, which we'll discuss here shortly as well. In chapter 6, we're still on the topic of merchandise. The difference between the two chapters is in chapter 6, we're going to talk about how to value merchandise, which is a more complex subject, and we'll cover everything in detail. And as always, if you have questions along the way, if you have questions along the way, please feel free to unmute your mic and ask your question. As always, so let's go ahead and get started. So, merchandise. What is merchandise? Merchandise is simply products, physical, tangible products that you would pick up from a store or from wherever, right? A physical, tangible product is like the pen that I hold in my hand. It is the coffee mug that I drink out of. Physical products, okay? And that's what we're going to be discussing. And we're going to talk about how to account for products in inventory, how to record transactions in inventory, how to go through the accounting cycle for inventory. And we'll also talk about how to analyze the physical products using ratios. All right, so when we look at physical products and we talk about inventory, there are two areas that we're primarily concerned with. One is on the balance sheet under the assets. As you should know, inventory is an asset. Physical products that the company sells is an asset. The reason why inventory is an asset is because inventory helps the company to generate revenue. That's why we have classified inventory as an asset. So on your balance sheet, you'll see accounts like raw materials, work in process, finished goods, or just simply inventory on the balance sheet. And inventory is an asset. Inventory, the word inventory means it's a product that the company has available for sale. And of course, when we sell inventory, we are making a sale to a customer, right? And when we make a sale to a customer of inventory, we take that inventory out of our inventory because we sold it, right? So it comes off of the balance sheet and it goes onto the income statement as a form of what we call cost of goods sold. We'll talk more about that as we get further, but let's focus on how the sale process works. So when we sell anything, whether it be a good or a service, we're generating this thing called revenue. Revenue is what the company is earning from the sale of a good or a service. That is what revenue is, right? Revenue is your sales. On the income statement, as you recall, the way the income statement is designed is it shows revenues, expenses, and ultimately net income at the bottom of the income statement. The income statement for a service company is revenue minus expenses equals net income. So revenue is always at the top of your income statement. Expenses are toward the middle and the bottom, and at the very bottom of your income statement is net income. But the formula for a service business to calculate net income is revenue minus expenses equals net income. Very straightforward. It gets a little bit more complex for a service business, as you might expect. I'm sorry, for a product business, as you would expect. A merchandise business or a retailer sells products to earn revenue. Makes perfect sense, right? So think of like Macy's or your favorite department store, right? That you go to buy clothing or sporting goods, auto parts, whatever it is. A physical, tangible product that you buy. It could be Amazon as well. Amazon is a retailer, but it's web-based. But if they're still a retailer, they sell physical, tangible products. So let's take a look at the income statement for a retailer. We have sales. It's called net sales. Sometimes it's just called product sales. It could be called just sales, net sales. There's a couple different names for accounts, right? And we know that. But a sales account is your revenue account. And the revenue for a merchandising business is typically in the form of simply sales or sales of products, things like that. So sales minus cost of goods sold. Cost of goods sold represents the cost of acquisition of the product that you sold. Okay, what does that mean? Cost of goods sold is the cost to the business to sell the product. The total cost of the product is your inventory. The total cost of the product is the cost it took the company to acquire and sell that product. So, for example, Macy's. At Macy's, I like to buy red t-shirts. So I go to Macy's and I buy a red shirt and it costs $20. And Macy's made the sale to me. So that $20 is a part of their sales. But what about, how does it look from Macy's side of things for the company, right? So for the company, Macy's sold the shirt to me for $20. But there was a cost to Macy's to sell me that red shirt. The cost to Macy's includes the cost of purchasing that red shirt from their vendor, from their supplier of red shirts. Okay? So it might have cost Macy's $2 to acquire that red shirt. So they sold it to me for $20 minus cost of goods sold $2 equals gross profit of $8 for the red shirt minus their expenses equals net income. And that's how the income statement is generated for a merchandising company. So if we compare the service company of Liberty Tax that does tax preparation to Nordstrom, which is a retailer of clothing and other goods, we can see the difference. Sales minus expenses equals net income is the income statement for a service company. And for a merchandising company, we have sales minus cost of goods sold equals gross profit minus expenses equals net income. So there's, the two additional steps basically on the income statement for a merchandising company: cost of goods sold and gross profit. Let's break it down. We're going to break all this down. So, merchandise. For me to be able to sell something, Mark, that's good to hear. For me to be able to sell something as a retailer, I need to go and purchase the merchandise to sell it, right? Makes perfect sense. So let's think about how does merchandise start? So let's talk about Macy's, Mark's favorite company, or Nordstrom, Mark's favorite company. So in order for Mark to buy the product from Macy's or Nordstrom, something must have happened for the product to even be on the shelf in the first place. It goes through a process. Now, you can think all the way back to the red shirt example. So let's say Mark wants to buy a red shirt from Macy's. Well, what does Mark need? How does the red shirt get to Macy's in the first place? So let's think about that process. It all starts with a purchase order. The business, Macy's, Nordstrom, sends a purchase order to their vendor, their supplier, to purchase a quantity of red shirts. Okay? That vendor receives the purchase order from Macy's, and that vendor sends a requisition form to the manufacturer of the red shirts, because obviously the product has to get made in order for it to go through the process. The manufacturer then starts the process of making the batch of red shirts. So what they'll do is they'll use raw materials, they'll use direct labor, they'll use factory overhead to manufacture the red shirts. Once it's completed, the manufacturer sells it to the distributor, who then sells it to Macy's. Okay. And then Macy's has to pay the distributor, and the distributor pays the manufacturer. And then hopefully Macy's sells the inventory. And that's how it works. That's how the retail pipeline, it all works, yeah? And so we can see it in this cycle. We send Macy's makes the purchase. Then we have the inventory. We sell it to our customers on account or collect cash. If we sell it on account, we collect the cash later, and the cycle repeats itself. Go ahead, Taylor.
Are manufacturers wholesalers or are distributors wholesalers?
Oh, good question. So it depends. It depends. So manufacturers can either be a wholesaler or they can sell to distributors.
Okay.
And it really depends in the industry, and it depends in the type of business that they're running. That's a really good question, but the answer is either or.
Okay, cool.
Yeah, great question. So that's the cycle. And it repeats itself over and over and over again. That's why we see that they are able to replenish all of their product all the time. Uh, s- so that leads us to our topic, which is the inventory system. We as Macy's, I'm just going to keep using that example. I hope you're all okay with that. So we're Macy's. We all work for Macy's, okay? So we're Macy's. We have an inventory system, and our inventory system we need to keep replenishing it, right? So we started the month with beginning inventory. You know, I'm not going to start the month with empty shelves, right? I start the month with beginning inventory, and I add in purchases, because we're going to keep purchasing more inventory. So your beginning inventory, which is what you started the month with, plus your purchases equals the merchandise available for sale. Merchandise available for sale simply means that we can have a customer walk in and that customer can purchase whatever is available for sale. Very simple. Can Macy's be a wholesaler? Well, it could be whatever you want. It's a retail business, yeah. So merchandise available for sale is made once it goes through the sale process. Okay, once we start selling the inventory, we have what's called ending inventory at the end of the month, plus cost of goods sold. Cost of goods sold, as I had mentioned, represents the cost of the inventory that the business is selling. There are two types of inventory systems that businesses have. Well, it's either one or the two. It cannot be both. Okay. One's called the perpetual inventory system. The other is called the periodic inventory system. I want you to
So I
think
think
of a scanner. Go ahead, Tyler.
um this is strictly for whatchamacallit, product based companies, right?
Yes. Yep. That's all we're talking about is
It's
product based. No service.
cool.
Yep. Excellent question. So I want you to think of two inventory of I want you to think of a scanner. Okay, a scanner. One of those devices that shoots a laser at a barcode and scans it. That's called a perpetual inventory system. It updates the accounting record at the for each purchase of this in sale of merchandise. So a barcode reader hits the barcode, right, when you scan it. And what that does is, if it's a cash register and a customer is purchasing, it's taking it out of inventory at that second, right? And so therefore, it keeps an updated record for the sale of each uh, piece of merchandise. And you can do the same thing when you receive the merchandise. So let's say you're working on the receiving dock of Macy's, and a big truck pulls up full of boxes of inventory, and you have to get that you have to receive it. That's why it's called a receiving dock. You have to receive it. You're receiving it into inventory, and the way to do that is you have a barcode scanner. You have a purchase. Um, a packing slip, and you have a purchase order, and you go through the packing slip and purchase order, make sure they match, and you go through the quantity and you look at the boxes, you match up the quantity with the boxes, make sure that you received everything you ordered, and then you start scanning those boxes into inventory. Right? So it works both ways. It's called the perpetual inventory system. It simply means it's perpetual. It continuously moves. It continuously updates. That's what perpetual means. It's continuous. The other inventory system is called the periodic inventory system. And this is a manual update process, and it happens at the end of the accounting period. Businesses that use the periodic inventory system are places like car dealerships. They sell infrequently. Infrequent means not regularly, right? They make sales once in a while. They make sales infrequently. It's a car dealership. Or a custom order shop that makes custom stuff, right? That's they use what's called a periodic inventory system. So okay, so let's say you have a jewelry shop on Etsy. That's custom, right? You custom make the jewelry. You probably use what's called a periodic inventory system, where you physically count the inventory at the end of the accounting period to know what you have on hand. That's called the periodic. So it's once in a while, right? It's done periodically. So those are the two accounting systems, and we'll get deep into the perpetual system because that is the one that's mostly used by retailers or merchandise companies. So let's do a couple of journal entries. I know you guys love these, right? So November 2nd, Z-Mart. Let's say it's obviously not Kmart because they're not around anymore. So let's call it Z-Mart. Z-Mart purchased $500 worth of inventory for cash from their vendor. So if we're purchasing inventory, which is an asset account, we debit merchandise inventory. Because remember, to increase an asset account, we debit it. To decrease an asset account, we credit. So debit merchandise inventory to increase our inventory. And we credit cash to decrease cash. And yes, these are both asset accounts. One's going up, one's going down. So there's a net zero impact on the accounting equation. So just remember the transaction process. First one is we bought the inventory using cash in order for us to be able to sell it to a customer. Later in the month, November 2nd, the next day, right? I purchased, I guess the same day. One I purchased with cash. The first transaction I used cash. The second transaction I'm purchasing on what we call on account. So as you recall, on account means that I'm purchasing it on credit for the store, right? So the store's saying, hey, listen, vendor, I'll purchase this from you on account and I'll pay you later. That's what that means. That's what on account means. Purchasing it now and I'll pay you later. So on November 2nd, our company, Z-Mart, purchased $500 of merchandise on account. When you see, remember, anytime you see the word on account, it's going to be accounts payable. When you purchase on account, it's accounts payable. When you sell on account, it's accounts receivable. So on account, we purchased inventory on account for $500. So we debit merchandise inventory and we credit accounts payable. Now there's a second part here, and I want you to understand this. We purchase goods, inventory, on account with credit terms. When you hear credit terms, it simply means that there's a deal in place with the vendor. And that deal tells us that we are purchasing this inventory from our vendor with credit term. It's a deal that's an agreement that's made between the vendor and the retailer. And the retailer's deal is 210 net 30. This is the credit term, 210 net 30. Here's what it means. 2 over 10. What that means is if I pay my invoice that I got from my bill that I got from my vendor, if I pay that bill, that invoice from my vendor within the first 10 days, I will receive a 2% discount. Okay? If I pay this bill within the first 10 days, I'll receive a 2% discount. And then it says comma N30. That means net 30. The bill is due in full within 30 days. But if I pay this bill within the first 10 days, I will receive a 2% discount. That's what this tells us. You might be asking yourself, well, Dr. B, why would these types of terms exist? Very simple reason. Vendors use cash to run their business, just like everyone else. To encourage someone to pay early, we offer them a discount. Make sense? You're all still there, right?
Yes, it makes
So
sense.
is that
Great. Thank you. Go ahead.
so is that saying are you saying that if a person has a bill and they pay it, can they still would you have to explain this all over again?
Okay, no, I got you. Okay, so there's an agreement between the vendor and the retailer, right? The agreement is if you pay me early, I'll give you a 2% discount. So early means if you pay me within the bill is due in full in 30 days. Okay, so the invoice says, hey, it's net 30, means it's due in 30 days. If you pay me early within the first 10 days, I will give you a 2% discount on your total bill. It's kind of like Jenny says, is it like cash back? Kind of, yeah, kind of. It kind of is.
It's also like if you go to the Nike store and you online, and if you order, say for instance, you put 2 pair of Nikes in your cart, and then you say, nah, I don't want them, and then you get ready to close out. Before you close out, they send you an offer, say, hey, if you purchase it now, I can give you 15% off. That's just to ensure that they will have their money because
Yep.
can't operate a business without dollars and cents.
100% right. Yeah, it's very similar to that. Very, very similar.
Yeah, I was thinking
Jenny.
like, how credit cards,
Yep.
they give you cash back for like certain stores and things like that.
Yep. It's
So I
similar.
was just thinking
It's an
something
incentive.
similar like that.
Exactly. You're exactly right. It's an incentive. It's an incentive for the person that is paying the bill to pay it early by receiving a discount. Mark, does that help to clarify for you?
Yes, it does. Thank you.
Fantastic. Thank you. And you all, I really appreciate that discussion. That's a excellent discussion. So to break it down again, we'll receive a 2% discount if we pay it within the first 10 days. Otherwise, it's due within 30 days. And that's what 210 net 30 means. And it could be other percentages too. It doesn't have to be just 2%. It's totally up to the agreement between the seller and the buyer. If the seller and the buyer agree to credit terms, it could be 5%, it could be 10%, it's whatever, right? But just know that the discount only applies for a certain number of days. That certain number of days and that discount is up to the agreement. And then otherwise the whole thing is due within 30 days or whatever the credit period is.
So let's say, for instance, if the person doesn't pay within the 30 days, what then happens?
Well, then they're in trouble.
It's pretty
Okay.
much past due by that
Then
time.
it's past due, exactly. And then sometimes, it depends on the agreement, right? If it becomes past due, there might be penalties and interest and all that. It depends on the agreement. But yeah, then it becomes past due, and then the harassing phone calls, and then everything else, right? Go ahead,
Uh,
Maria.
Question. So
Yep.
I have a question actually about that. So would it be if that past due part is added within this, like after this,
Hmm.
they would say if not, then if past due 3% interest will be included, right? They would say that on like the invoice,
Yeah,
correct?
it would have to. It's basically like a contract, so it has to be explicitly mentioned. Yeah,
Okay.
great question. Okay, very, very good. Thank you so much. Okay. Yeah, exactly right. Yeah, so the credit terms are only available for a specific amount of time. Um, Now, when that time lapses, this just kind of shows you in another graphical way. We take the deduction off of the invoice price, right? So if in other words, I'm Macy's. I buy a bunch of red shirts. Let's say I bought 5 red shirts at $2 a piece. That's $10. So my invoice is $10, and my vendor says, "Hey, listen, Macy's, if you pay this $10 within the first 10 days, I'll give you 2% discount." Great. So when I go to pay that invoice, if I pay that invoice within the first 10 days, I will send them a check for the what is it, like $8, right? Or oh no, it's not even that high. It's like $9.20 or whatever. So I'll send them the check for the reduced amount if I pay it within the first 10 days. Otherwise, I pay them the whole $10. And it's always from the date of the invoice. So here's an example of an invoice. It's always going to have a bunch of information on it: who sold it to you, the um, who sold it to you, the invoice date. Date is very critical. We all know that dates are important in accounting, right? So the invoice date, the purchase order date, it'll have information like the terms, 210.30. It'll have freight terms. Oh, freight terms is another interesting one. We'll get more into this in this chapter and in later. Go ahead, Mark.
So when you said dates are important in accounting, why is that?
Well, think of the matching principle, Mark. So the matching principle tells us that we need to recognize revenue and expenses in the time frame or the accounting period in which they have happened. So if I received this invoice and it was for on November 2nd, and it was for a inventory that I am selling in the month of November, then I need to make sure that I record this invoice, this bill, for November 2nd. So that's why the dates are so important in accounting, because we got to make sure that according to the matching principle that it matches with when the revenue is being recognized.
Okay, I got you now.
Yeah.
That makes sense.
Cool. Great question. I appreciate you asking that. Number 6 on here is freight terms. Freight terms is this. It tells us who is responsible for the merchandise as it's in transit. Who's responsible for the merchandise as it is in transit? Is it the customer or is it the vendor? Okay, that tells us who's responsible. FOB means free on board. We'll talk more about that. And number 7 on here shows us the list of the quantity, the price, each amount, what the product is, model numbers, so that the detail of what's being sold. And of course, it'll have a total amount. It might include things like a subtotal, shipping, taxes, and then it'll also include it might include number 9. It doesn't always include number 9, but the net amount. What you would pay during the discount period.
Professor.
Yeah, go ahead, Mark.
So go back to that screen right there. So let's say, for instance, if I ordered a HP laptop
Sure.
and the HP, which is the company, sold it to me, and on it they
Mhm.
basically I didn't pay the $1,500 for the laptop, and they sent me the invoice. So
Mhm.
within the 30 days, I pay the what is it, $1,000.
Sure.
Does that mean that I would still owe them the $500 within the 30-day period?
Yeah. So good question, Mark. So let's say you received a bill, invoice from HP for $1,500, and that was on the total line, the total amount. It said 1,500, and within 30 days you paid them 1,000. You would still owe them 500, and that 500 will be in the form of a second bill probably if it's late. But yes, otherwise you owe them the full 1,500 within that 30 days.
Okay, so now that makes sense. I got you now.
Cool.
That makes sense.
Great question. I like that. It's a very good question. Okay, so we talked about how the first transaction we talked about was we purchased inventory using cash. The second one I showed you how to do it using on account, accounts payable. Now on November 12th, this is 10 days later. Now remember, the invoice said that if I pay this within the first 10 days, I can get a 2% discount. So let's do that, right? I want that 10%. Hey, listen, any discount's a good discount. 2%, I'll take it, whatever. So let's figure out how we're going to pay this with the discount money. Now, November 12th, on November 2nd, I received my invoice. It said that I owed them $500 within 30 days. Otherwise, if I pay them within the first 10, I can get a 2% discount. So my first transaction is I already put it into accounts payable at 500, right? I debit my merchandise inventory 500 and I credit accounts payable 500. Now on November 12th, 10 days later, I'm going to pay that and I'm going to take advantage of the discount. So how do we do that? You might be asking. We debit accounts payable the 500 because remember that's how much the total invoice was for. But I'm only going to pay them $490 because for $490 that's how we get. How do we get the 2% off of 500? $500 times the 98% gets me $10. $10 is my 2% discount, right? So we debit accounts payable 500 to reduce the accounts payable by the full amount that we put in. We credit merchandise inventory $10. What that does is we are reducing the total cost of our inventory by the $10 discount.
Question.
Yeah, go ahead, Tyler.
Okay, so this part confused me. What, like, it makes like surface sense, but why am I decreasing the cost of the inventory that I paid for if I still paid like a set amount?
Where else are you going to take the discount out of? So think of it this way,
That's a good
Tyler.
point.
Think of it this way. If the merchandise originally cost us 500 and we're going to take advantage of a discount offer,
Yes.
we need to reduce the total value of our inventory by that amount
Okay, yeah, that makes sense.
because
Right,
that's
right.
where it came out of, right? Yeah.
Okay.
Good
Yeah.
question.
Oh, right. Yeah, that makes sense.
Excellent question. Go ahead, Mark.
Oh, I don't have anything.
Oh, okay, no problem. I thought you might have, uh, okay, no problem. So we debited accounts payable 500. We're going to credit merchandise inventory to reduce our inventory value by that discount amount, $10. And we're going to credit cash $490. The $490 represents what I'm actually paying using my discount. Make sense? Cool.
So this is what all discounts on any merchandise or product is taken
Yeah,
with
absolutely.
merchandise.
Yep, you're right. That's the same process. It's the same
Okay,
exact process for any discount. Great question. Okay, so as you know, the accounting cycle, right? So we just did step 2, which is make the journal entries. Now we're posting them to the ledger, to our ledgers, right? As you recall, a ledger is simply a running total for each account. So looking at our ledgers, I received the bill on November 2nd, 500. I paid it November 12th, 500 to reduce the payable, 0. Merchandise inventory. I received the merchandise at a value of $500, November 2nd. November 12th, I took $10 off of that value to represent the discount that I earned. So $490 is the remaining balance of merchandise inventory. Remember, merchandise inventory, that's an inventory account on the balance sheet. Go ahead, Taylor.
Okay, so because I'm still working on differentiating journals, ledgers, and the trial balance.
Sure.
So there's each like the accounts payable is its own like ledger account, and then the merchandise inventory is its own ledger account, right?
Correct.
Okay, and with the trial balance, I know that's when they get ordered by liquidity, right?
That's right. Yep. And the trial balance is toward the end of the accounting cycle. That's when right before we close out our books for the month.
Right. Okay, and then so would it be ordered cash, inventory, payable, accounts payable? If it was
That's
just these three?
correct. Yep.
If
It
it-
would be cash inventory and then, your other asset accounts and then, your liability accounts like accounts
Okay.
payable and so forth.
All right.
Yep. Excellent question. And then of course we paid cash $490. It's kind of nice to walk through the whole accounting cycle just with a couple of examples. Definitely helps. So the payment after the discount period, pardon me, still getting over the little cold I had. So the payment discount, payment after the discount period. What this simply means is if I don't pay that invoice within that first 10 days, I owe the total amount within 30 days, right? Because that was the credit terms. So let's say instead of me taking advantage of that discount, I'm going to just pay the whole 500. So we would just simply debit accounts payable 500 and credit cash 500. So in other words, this is, I missed the discount period. This is what the journal entry would be. Okay. Returns and allowances. Oh my goodness. Oh, I hate returns. Oh, I hate allowances. Here's
Why is that, Professor?
What's it, Alexis?
I said, why is that? Why do you hate them?
Oh man, well, when you own the business, you don't want stuff coming back to you. You know what I mean?
That's the last thing I want because I want all my money worth that I
You
spent
don't
to
want to owe
send
them.
it to you.
That's it. That's right. Exactly. Come on now. I don't want to be having to give somebody no refund.
No,
It's the worst.
well,
Go ahead.
but okay, I was going to ask, well, how come when they do that, they do credited things? They say, okay, you can switch or you can do something else, but some retailers don't give you your money back.
Yeah, no, excellent question. So there's a couple reasons why certain retailers have those
Amazon.
type of policies. Yeah. And it's not always the same, right? Retailers have different policies. Like, for example, let's say I bought a red shirt from Macy's and I bring that red shirt home and I decide, you know what? I don't like this or it's too red or it's a little off. it don't fit. Okay. If I return it to Macy's within X number of days, whatever their policy is, I think it's like 30 days, or maybe it's less. It might be 2 weeks. I don't know. So let's say I'm like, oh, you know what? I don't like this whatever stuff I bought. I bring it back to Macy's within that time period that's on the receipt. It says returns within X number of days, full refund. Uh, or it might say certain merchandise, there's no refund. Certain merchandise, you can exchange it after a certain time period. Those are the policies set by the store. So let's say I bring the red shirt home, I try it on, it don't fit right, don't look right. Then I put it back in the bag, bring it back to Macy's. They give me a cash refund during a certain time period. Now, let's say it's a different kind of product. Let's say it's, underwear that I bought from Macy's. I tried it on. I don't like it. I bring it back. They're like, "No, dude, we're not taking your dirty underwear. Sorry, that's our policy." Okay. So, yeah, that's totally up to them. So they might say, "Hey, you know what? Instead of us taking back your dirty underwear, we'll give you what we call a purchase allowance." Uh, which is basically like saying, we'll give you a discount.
It's like a store. It's like a store credit.
Store credit.
Basically,
Exactly.
it's like with Macy's. If Amazon does the same thing sometimes. So if you order something and you send it back and it's defective, they'll give you either a store credit or they'll give you a credit based on the amount that it was for, if that makes sense.
You got it. That's exactly right. And that works the same way. Yeah, you're 100% right. And that's where the concept of purchase allowance comes from. Because in retail, as we know, there's a lot of different retailers, and there's a lot of different policies out there. So to answer your question, or at least to add to the discussion, is those policies are set by the individual stores. There's no like governing body that says you have to do certain things. Like you could have a store and you could say no returns, period. Right? It's like we've all been to those types of stores. Or at least I have. Where you go to a store and they're like, "Oh, we don't do returns." That's their policy. Okay, cool. I guess I won't be bringing stuff back. I'll just sell it somewhere else.
Excuse me, Professor.
Yeah, go ahead.
Yeah,
No
on
worries.
certain items, they say, like in the stores, they let you know, like if it's final sale, you
Yeah.
can't return it or anything.
Yeah, exactly. Yeah, you're absolutely right. And a lot of times that applies to like cosmetics. Like what are you gonna do? Go bring the makeup home, try it on, say I don't like it, and bring it back? They're not gonna take it back. Well, they can't resell it. You
Yeah,
know?
like swimsuits and underclothes, whatever.
Exactly. They can't resell that stuff. That would be unethical of them to try to resell something like that. So, purchase returns.
But
Go ahead. Go ahead.
Dr. B,
Yeah,
I
Nassim.
have heard that some stores need proof to the wholesalers that there is defection. This especially goes for like I know some parts aren't, but some wholesalers, this is what I've heard. You could actually tell me if I'm wrong, would like proof that there is defection in the product.
Yeah, you're
Correct?
right. And
So they
that's
take the return
mhm.
just because it goes on the wholesaler's expense then, correct?
Yeah, because the wholesaler takes the hit on those types of returns. So an example of that, Nassim, would be let's say you bought a television from directly from Sony, okay? And your Sony television, you plug it in, and it doesn't turn on, or it turns on and there's a huge line across the center for whatever reason. Okay, it's defective, obviously. So you need to prove that to Sony before they'll buy it back, or that before they'll take it back. And the reason for that oftentimes is there's so much cost with having to replace that television, right? So they want proof that it's defective. So the answer is yes. And oftentimes that's with electronics. Yeah, that's an excellent question.
Professor, I think another another like a scenario would be if somebody order like purchase food and for some reason it went bad for whatever reason, they bring it back. Um, is this how they detect they detect things are defective when it comes to food, like if there's like salmonella exposure and stuff like that?
Yeah,
Or
yeah.
okay.
That's oftentimes how that works. Like for example, we had an outbreak recently. I think it was like lettuce or something like that. Uh, that was salmonella in like 9 states out west. And so, how did they figure out that there was a problem? Customers got sick, brought it back, told them they got sick, and then all of a sudden word started spreading. Oh, this product. And then if you had enough of those cases, that's how they find those types of problems. So yeah, that's exactly right.
Okay, and then I'm also trying to figure out like how long is that process even? Like would it take months, weeks?
Probably a couple weeks. Probably a couple weeks.
Okay.
Yeah, good question. And it's always case by case, right? So with purchase returns, merchandise is returned by the purchaser to the supplier. That's a return. It's just called a return, purchase return. Purchase allowances. If something's defective or we can't take it back for whatever reason, we'll give you a discount. That's what an allowance is. So purchase allowances. November 5th, our company issued a $30 debit memorandum for the allowance from a deferred for defective merchandise. So, in other words, what happened? Our company bought a whole batch of inventory. Some of it didn't work. So, what do? I'm going to deduct it. So, how do I deduct it? Debit accounts payable, credit merchandise inventory. When you credit merchandise inventory, as you know, we're reducing the value of that inventory. And with the accounts payable, we're increasing it because it's a debit memorandum. So here's how that works. I'm going to return that bad inventory. Yeah. So I already paid the bill. So I gotta figure out how to get it returned. So here's how that looks. Now let's go back a step and identify the original purchase. We originally purchased inventory for $250 back on June 1st. We debit merchandise inventory to increase the merchandise inventory, and we credit accounts payable to increase the accounts payable, right? And that was on terms 210 net 30. We, on June 3rd, we realized that some of our inventory is defective. So, and we contact the seller and say, "Hey, seller, my junk is broken that you sold me. I'm going to send it back to you." Okay. So we debit accounts payable to reduce the accounts payable by the defective amount, in this case $50 worth, and we credit merchandise inventory to take it out of our inventory. On June 11th, we go to pay our bill, that we received on June 1st. We're still taking that discount. I mean, we're still paying it within 10 days, but we're also going to send back the broken inventory of $50. So I'm going to debit accounts payable 200, and I'm going to reduce the accounts payable to 200. I'm going to credit merchandise inventory by $4 to represent the $4 discount. The $4 discount, as you recall, came from the fact that I paid it within the first 10 days. I got a 2% discount on the $250 order. So $200 accounts payable debit to reduce the total accounts payable. Merchandise inventory, I credit to reduce it by the value by $4 to recognize the discount that because I'm paying it within that first 10 days. And I'm credit cash 196 to pay the bill 196. Go ahead, Mark.
I don't have nothing to say. Go. I'm sorry.
Oh, no problem. That's all right. Okay, cool. So earlier I mentioned this thing called FOB, means free on board. We first saw that when we looked at the invoice that we received from our vendor, right? So FOB means free on board. There are these things called shipping points. Shipping point means where it's coming from. Yeah. As we know, when we buy something, our business, when we buy something, we got to get it from somewhere, right? It comes from our seller. The seller sells it to us, the buyer. The seller's got to get that product to us somehow, right? And who pays for the shipping? Who pays for the shipping is what we call shipping terms. Who's responsible for it? Okay. So when you see free on board shipping point, it means that the buyer is responsible for the product as it's in transit. And so the buyer pays for the transportation cost to get it to us. And to do that, we debit merchandise inventory by the cost of the transit to increase the total cost of inventory. And we credit cash. Now, the reason why we debit merchandise inventory to include the cost of the merchandise and the cost of the transportation of that merchandise to us is because merchandise inventory represents the total cost of inventory. The total cost of inventory means the original purchase price of inventory plus the cost of getting it to us plus the cost of insurance, if there's insurance, plus whatever, right? The total cost of the inventory. That's merchandise inventory. We credit cash. FOB destination means that the seller is responsible for the cost of the transportation of the inventory. And in that case, what they do is they debit delivery expense and credit cash. Right, so our company is responsible for merchandise that we purchased by shipping point. So there's a transportation charge of $75. I debit merchandise inventory to increase the total cost of my inventory by $75, and I credit cash $75. Itemized cost of purchases. Okay. Itemized cost of purchases represents what we call the net cost of purchases. Purchases, we're talking about purchasing inventory, obviously. So we have the invoice cost of merchandise purchases minus any discounts, minus any returns, plus transportation cost equals the total cost of merchandise purchases. So, and these types of reports are usually generated for you. So we're not going to dive too deep into that. Let's analyze and record our transactions for merchandise sales using the perpetual inventory system. Now remember, we talked about two types of inventory systems: perpetual, which means continuously updating, and periodic, which means we update it at the end of each accounting period. Under the perpetual inventory system, we recognize our sales on our income statement, sales, when you see net sales, it's net of discounts, returns, and allowances. So sales minus discounts, minus returns, minus allowances equals net sales. Net sales. You see net, it means the net of. That's after any deductions or additions. Net sales minus cost of goods sold. As you know, cost of goods sold is the total cost of selling inventory to our customers. Equals gross profit. Gross profit is your profit before all of your expenses. That's how we compute gross profit. Net sales minus cost of goods sold equals gross profit. And that's always at the very top of your income statement. When we sell merchandise, each sale involves two parts. And this goes back to our revenue recognition principle and our matching principle. There's two parts when we sell merchandise. Number one is we receive the cash from the customer from the sale, obviously. And we also recognize the cost of the merchandise we sold to the customer. That's taking it out of our inventory and putting it onto the income statement as a form of cost of goods sold. That's what that tells us. So here are the journal entries. You guys love journal entries, don't you? I know you do. Okay. Our company sold $1,000 worth of merchandise on credit. It was on credit. And the merchandise had a cost of $300. That's a pretty good profit margin if you ask me. I mean, man, y'all got $700 in gross profit from that. Look at that. That's amazing. Okay, let's walk through it. So on the sales side, we made the sale, right? So we debit accounts receivable because we sold it on account. Otherwise, it would be cash when we got cash for it. And we credit sales. When you credit sales, you're recognizing the increase in sales. When you credit sales, you're recognizing the increase in sales. Remember, sales is a part of equity. Remember the expanded accounting equation, right? Assets equals liabilities plus equity. Under equity, we have net income plus revenue minus expenses. The revenue is sales. It's an equity account. That's why it's credited to increase sales. So that's the sales side. Then we got the credit side of the journal entry. Or the cost side, I'm sorry. The cost side of the journal entry. Because remember, it cost us something to sell the inventory. It cost us $300. So we debit cost of goods sold $300 and we credit merchandise inventory $300. What that does is it takes the inventory off of the balance sheet, puts it onto the income statement. Takes it out of inventory, right? So every time, and I mean every time, you sell inventory, these two transactions exist. That's how you properly track your cost of goods sold. Very, very important. Sales discounts. So when we give a sales discount or to benefit a buyer, when we issue a sales discount, it works the same way as it did when we were the buyer, right? So here's how that looks. Sales with cash discounts. So now we're selling the product. And in order to get our customer to pay us early, we'll offer a discount. Okay? We'll offer a discount for the customer to pay us to get the customer to pay us early. So we decided to issue our customer a discount offer of 2% if they pay within the first 10 days. Otherwise, the whole bill is due within 45 days. 210 net 45. So first thing we do, we have to recognize that we made a sale November 12th. Debit accounts receivable, $1,000 to increase accounts receivable. Credit sales, $1,000 to increase sales. 210 net 45 were the sale terms. We debit cost of goods sold, $300 because the inventory cost was $300 that we sold. And we credit merchandise inventory, $300. November 22nd, our customer paid us early within their first 10 days. They took advantage of the 2% discount. So we received $980 in cash because our customer decided to take advantage of the 2% discount we offered them. So debit cash, $980. Then we debit this other account called sales discounts. Sales discounts. Sales discounts, pardon me. Sales discounts is an account that we use to recognize the amount of the discount we offered to our customer when they paid it within that time frame. In this case, $20. Then we credit accounts receivable, $1,000. And what that transaction shows us is the customer paid us within that first 10 days, we gave them a 2% discount. Now remember, the reason why businesses do that is because business is run using cash. You have to have cash in order to run a business. Yeah. And so that's why oftentimes you see these types of discounts, is to incentivize somebody to pay you early or somebody to buy your stuff. If the customer paid us after the discount period had ended, we would simply debit cash, $1,000, credit account receivable, $1,000. Sales returns and allowances. The customer not happy with us, so we got to make them happy. Businesses live and die by customer happiness. You all understand that, right? You know, I don't shop at places that I don't like. Right? And I'm sure the rest of you feel the same way. If somebody treated you badly, there's a good chance you're not going to go back there. Right? So I'm with you on that. I feel you, right? I don't shop at places I don't like. So in order for a company to save what we call save the sale, you got to make the customer happy. Right? If a customer comes to you, they're not happy, you got to make them happy. Otherwise, your reputation is going to suffer. And business reputation is everything in business. I promise you that. Okay? Your business will go out of business if you've got a bad reputation. So, here's how it works. Sales returns and allowances. Customer comes to us, they're not happy. We've got to prevent the loss of a future sale. How do we do that? Couple different ways. We can accept the return, give them a refund, or we can offer them a reduction in the sales price, give them a discount because, you know, we want to save the customer. So we have a customer came to us. Well, they weren't happy. Okay. So customer refund. We debit sales returns and allowances. That's the name of the account. Sales returns and allowances. We debit sales returns and allowances when there's a return of inventory. And we credit cash to give the customer their cash back from the sale. That's if the product is not defective. And you know, we can resell it, right? If we can resell the inventory, then we would debit merchandise inventory to put the inventory back into our inventory available for sale. And we credit cost of goods sold to reduce our cost of goods sold because it was returned. right? Got to reduce your cost of goods sold if it comes back, because it's no longer sold at that point. Yeah. Now, what if it is defective when the merchandise comes back? Okay. We salvage what's not defective by debiting merchandise inventory. What is defective, we debit this account called loss from defective merchandise. Loss from defective merchandise, we debit that if the merchandise is defective. And we credit cost of goods sold. I'll tell you this, the loss from defective merchandise account, when that's used at the end of the year, when you go to do your taxes for the business and you see this loss from defective merchandise, you can write that off. Just that's a little side note for those of you who have businesses that deal with that type of stuff.
What about, can you go back real
Angel?
quick? What about if your return goods is not defective, but you don't get full price for it? Do that in turn, how would that affect how you put it in your journal?
It would be that first journal entry you see there. The sales returns and allowances would be debited, and then we would credit cash. But it would be for a reduced amount.
Okay,
Yeah.
thank you.
You're welcome. Good question.
I have a question.
Yeah, go ahead.
So let's say, for instance, you're Amazon, and you
Okay.
sold me some defective headphones, and Amazon sends me the box and the label and all of that.
Sure.
Can Amazon issue the credit, or does the credit have to come from the merchant?
Oh, that's a good question. So since Amazon is in what we call an intermediary, right? It's a platform. With intermediaries like Amazon, they have their own policies, right? That the merchant has to abide by. So Amazon would issue you the credit, and then Amazon would go after the merchandiser or the seller for that part, if you will. So short answer is Amazon would issue that credit in that situation. Good question.
Thank you, sir.
You're very welcome. Marina, were you going to say something to that effect, or?
Yeah, so my question was, how do you determine the merchandise inventory amount once something is effective?
Oh, that's a good question. So, so this third transaction here, the November 26th,
Mm-hmm.
E3, if you will. So with that particular one, it depends on if all of the inventory that came back is broken or not. If it's all broken, then that would be zero. Merchandise inventory would be zero.
Mm-hmm.
And then it would all go to a loss. So it really depends. It depends on how much of it is broken that comes back.
Okay, and they just determine it based on a percentage, or like
That's a
it,
good question. So in accounting, and that's actually more managerial, but I'll tell you.
mm-hmm.
So the way it works is typically a business will estimate a percentage of what's going to come back broken. If all I do is sell pencils, for example, and I expect that 2% of all pencils that I sell will come back to me broken. There's another account called the allowance for doubtful accounts, or I'm sorry, allowance for defective merchandise, and
Mm-hmm.
it would be allocated there, and then at the end of the accounting period, we would make adjustments.
Okay.
Yeah, good question. That's a very managerial question.
Thank you.
Yeah, cool. Great questions. Yeah, Dario. Amazon's like a third party. Exactly. It's a platform. It's like you know how you request a cab ride through Uber. It's the same thing. It's a platform that you go to, and it's an exchange between two other parties. But they also sell their own stuff too, so it's a little different. Amazon's its own animal. Okay, let's assume that $40 of merchandise we sold on November 12th is defective, but the buyer decides to keep it instead. Well, we're going to be nice, okay, because we're nice. And so we're going to give that customer a price reduction because the fact about they're going to keep it. So we'll debit sales returns, allowances, and credit cash. Yes, once in a while that happens, but most of the time nobody's going to keep something this broken. Unless it's like, the zipper's torn, but I could live with that. It's like, then you go to the manager, talk to the manager, get a discount, blah, blah, blah. You know how that works. All right, so adjusting entries. So at the end of actually, Marina, this will help to answer some of that question that you had, the adjusting entry. So when we make adjusting entries in the accounting cycle, we know that we make adjusting entries toward the end of the accounting cycle, right? Before we go into the unadjusted trial balance and then the trial balance. So we make our adjusting entries. So when we make our adjusting entries, we adjust for various things that happen, right? One of those things could be theft. Theft happens. Unfortunately, that's part of life, right? Theft. So you have you run a retail business. Somebody steals your stuff. You still have to account for what was stolen, because you shouldn't be responsible for carrying this inventory that you don't have because somebody stole it. So at the end of the accounting period, we make an adjusting entry for that. We debit cost of goods sold and we credit merchandise inventory. What that does is it shows that it's sold, but it's really not sold. I mean, we didn't sell it, but we still had a cost associated with that inventory, and the inventory is no longer in our possession. So we debit cost of goods sold and credit merchandise inventory. Then you're probably thinking, well, what happens? It was stolen, so it's not really cost of goods sold. Well, then there's a, I think it's a little bit more complex, but then there's a process by which we do this write-off, and it's called allowance for doubtful accounts. It gets muddy. We'll talk about that in Principles of Accounting 2. But for our merchandise business, we have to go and do what we would always do, and that's close our temporary accounts at the end of the year. We debit sales, credit, income summary. Income summary, as you recall from the closing process, is representative of our retained earnings. Debit sales, credit, income summary to close out our sales accounts for the year. Step 2 is we close out all of our other temporary accounts, which is our expenses. We debit income summary and credit all of our expenses. Now remember, we do this at the end of each month because we got to start the next month with 0 sales and 0 expenses because they're temporary accounts. They don't carry over from month to month. And then we debit our total income summary to our paid in capital account. And then our paid in capital account, we also take out any withdrawals. 1, 2, 3, 4. It's the same exact process that we walked through last week. Okay. There are 2 types of income statements that are possible. One is called a multi-step income statement. The other one is called a single-step income statement. They're both income statements. One has more detail on it than the other. Obviously, the multi-step is the one that has most of the detail, and let me explain that. On a multi-step income statement, you have sales minus sales discounts minus returns and allowances equals net sales minus cost of goods sold equals gross profit minus your operating expenses equals your income from operating expenses minus your plus or minus your other, we call it other. Other includes things like interest revenue that you got from a checking account, or you sold some property, plant, and equipment, minus interest expense from a loan that you have or whatever equals total other. So we have gross profit. We have minus total operating expenses equals income from operations plus total other revenue or minus expenses, depending on what it is, equals net income. You see that it's called a multi-step because it's expanded. There's multiple steps to the process of generating this income statement. On a single step income statement, it's consolidated. It's simply total revenue minus total expenses equals net income. And it's a lot more condensed, right? That's why I call it single step. Multi-step, single step. On your balance sheet is always organized in the order of liquidity. Assets equals liabilities plus equity. We know that total assets, total liabilities, total equity, they all show up on your balance sheet. These, each category on the balance sheet, assets, liabilities, equity, are organized by what we call liquidity. Liquidity simply means the ability to convert something into cash. So on the balance sheet for assets, we have cash, then accounts receivable, then merchandise, inventory, office supplies, store supplies, prepaid insurances. Those are all current assets, right? Remember, current assets means current within 12 months. And it's organized by liquidity. Liquidity simply means how quickly you can convert something into cash. That's what liquidity means. Earlier, I had mentioned that we can analyze our inventory using ratios. Ratios are really important because we as managers can quickly compute a ratio to determine if the company is utilizing their current assets appropriately. In other words, are they quickly turning over inventory? Are they quickly utilizing their cash? So we one of those ratios is called the acid test ratio. It's where we take quick assets divided by current liabilities. I can already hear you now. You're like, Dr. B, what the hell is a quick asset? I've never heard that term before. You're right. It's not on the balance sheet. You'll never find the word quick asset on the balance sheet. There's nothing quick about it. So quick assets means we take cash plus any short-term investments plus accounts receivables. The reason why they call them quick is because those are the things that can be quickly converted into cash, divided by current liabilities. And what this represents is of any value of 1 or above is unlikely to face liquidity problems in the future. So let's look at Nike, for example. We could run the asset test ratio. Remember, quick assets divided by current liabilities. Quick assets are cash plus short-term investments plus receivables divided by current liabilities. And then looking at this, our asset test ratio shows a 1.8 for the current year. Anything above 1 is good. That means the company has the ability to be liquid. They have the ability to satisfy their current liabilities. That's what it shows us, right? And in comparison to Under Armour ain't doing so well in the current year. They did well the year before. So it's helpful. It's helpful for managers to see this type of information. Now, one of the most important ratios, in my opinion, is called the gross margin ratio. Gross margin. The word margin represents profit. Margin represents profit, okay? And that's what the word margin means, profit. Gross margin, gross profit. What this tells me is the company's ability to cover their expenses using profit. Okay, company's ability to cover their expenses using profit. So to calculate this ratio, we take net sales minus cost of goods sold divided by net sales. Net sales, as you know, top of the income statement, net sales. That's your sales minus your allowances and all that junk. Gets you to net sales. Minus cost of goods sold. Cost of goods sold represents the cost of the inventory that you sold divided by net sales. That tells us our gross margin ratio. Then, of course, the higher the ratio here, the better.
Excuse me, Professor.
Yeah, please.
Why in the gross margin ratio the net sale is used twice?
Yeah, great question. So, as you know, with any ratio, to calculate a ratio, we need what we call a base. And the base represents what we're comparing it to. And so that's why we have net sales shown twice. Net sales minus cost of goods sold is, as you recall, gets you to your gross profit, right? Net sales minus cost of goods sold equals gross profit, correct? And so gross profit divided by net sales is the ratio. That's why we see it twice.
Okay, thank you.
Great question. Yep. Yep. And this just kind of shows you the differences between the periodic and perpetual inventory systems. We're not going to dive too deep into that because it's really not as we don't go too deep into that part in this course. The adjusting entries, as I'd recommend, as we had discussed before, adjusting entries are used for making adjustments that have happened after the accounting period has ended. So an example of that would be something like sales discounts. If a sales discount is utilized within that accounting period, we can make that adjusting entry. So debit sales discounts and credit allowance for sales discounts. And this is for Marina, as you and I talked about earlier, you would use this type of adjusting entry for the allowance of future discounts. This would be the adjusting journal entry that you would make for the allowance for future discounts.
Okay.
I have a question, Professor.
Yes, please, Alexis.
My question is, so with them having the allowance of sales discounts for the future discounts,
Mm-hmm.
are they just looking at, okay, if they put this discount out there, what profit can they bring?
Yeah, so the reason why we have something called allowance for sales discounts is we're estimating that a certain percentage of our customers will take advantage of that discount. And that's what the word allowance for future discounts essentially means. And so, and as you know, that's a way to attract customers to pay their invoices early. I hope that helps to clarify for you.
Yeah, it does. Thank you.
Cool. You're welcome.
Okay, and then just to clarify, the allowance for discounts, the sales discounts just depends on how much we already know is being put in accounts receivable.
Yeah.
So okay,
Yeah. It's typically based off of what's already in accounts receivable.
and then just taking the 2% from there if it's like 2% discount, correct?
Exactly. And then if they don't take that discount during that accounting period, you can just simply reverse the entry.
Okay.
Yeah, good question. Okay. I think we're there. Let's see. Sorry. For some reason, it's not there. Yep. Okay. All right, cool. That's the end of chapter 5. Any questions so far?
This PowerPoint is on Blackboard.
Yep, everything's on Blackboard. So we're in week 3, right? So if you go onto Blackboard and you go under course content, select it'll be, I think it's learning module 2, and it'll be week 3.
Okay, thank you.
Good question. Man, I can't believe we're on week 3 already. Any other questions?
Professor, I have a question.
Wow,
For the
yes.
midterms, I saw you said it's gonna be the 19th. We have one attempt for midterm. So
That's right.
what chapters is it gonna cover?
It'll cover the first part of the course, so it'll cover chapters 1 through, I think it's
1
8.
to 8?
That sounds right. Yeah.
Okay.
Yep. Good question.
And how
Yeah.
are the questions? Is it like multiple choice or is it like
You
an essay or how do you?
No. I don't do essays. So it's a
Okay.
mix of multiple choice, true, false,
Okay.
some matching. Yeah.
All right. Thank you.
Yeah. Good question.
Mhm.
Okay. Any other questions before I stop this recording? We'll start the next chapter, and we'll take a short break, like maybe 2 minutes. You all okay? All right. Great. Maybe we'll stop this part of the recording now. We'll start with chapter 6 here in a few minutes.